All right, let's draw some insights now from the Afrinvest H1 2025 Macroeconomic Review and H2 2025 Outlook report, aptly titled Silver Linings, Statistical Gains, Social Strains. This comprehensive analysis delves into the performance of both the global and domestic macroeconomic landscapes, examining key indicators, market trends, and policy development. So joining us to help unpack this, we have Damilare Ashimi, who's a macroeconomic strategist at Afrinvest Research and Consulting. Great to have you on the show.
Good afternoon, Ladi. Thanks for having me.
Good afternoon, Dari. Great to have you as usual. But, we're seeing, this is the time to, take stock and kind of, predict, what's to come, at this time with all of the uncertainties. And we're seeing the IMF, they've downgraded 2025 global growth projections to about 2.8%, citing reinflation risk, geopolitics, and supply chain challenges. So what are the most significant global headwinds that could continue to impact the economic performance in H2, from what you've seen play out in the H1?
Yeah, thank you very much, Ladi. Well, thanks for having me on this show. I mean, you've actually mentioned the major theme that has been shaping and will shape global economic momentum in the rest of H2, and that is geopolitical tension. After the pandemic in 2020, there was reflation across the globe. Central banks injected a lot of liquidity, which helped reflate the global economy in 2021. And the resultant effect of that massive injection, above 15 trillion at some point globally, led to inflation, which was the global theme in 2022, 2023. Yes, there was also Russia invasion at some point when it invaded Ukraine, truncated flows of trade, global trade, and what have you. But at the time, we thought that the global economy was having a sort of convergence in terms of normalization of some of those initial concerns. Then geopolitical tension began to take a new turn, both in terms of physical warfare and in terms of trade war, because whether it is tariff war or the one that involves carrying gun, is still geopolitical tension, because when countries that normally trade with each other before seamlessly began to input impediments, then there is a knock-on effect, especially because the countries that are at the forefront of this development are the major powers. You talk of the US, you talk of China, you talk of the European part of the world. So basically, the major risk now that the global economy has is geopolitical risk, which has both the form of tariff war as well as physical tension, like the one between Israel and Iran over the couple of weeks, which holds a sort of negative outlook for oil market, you want to say, because yes, a disruption from Iran can cause a spike in price, but again, following the experience of what happened to Russia, a lot of countries have, somewhat looked for a better alternative to meet their needs, and that's why, unlike when Russia invaded Ukraine, the prices spiked to above $100, we didn't see the same kind of thing between Israel and Russia, even before a sort of ceasefire agreement was reached, because Trump has said, drill, baby, drill, drill. The US is pumping as much as possible. So basically, the risk around the globe, which is around geopolitical tension, is very dynamic, and we think that will continue to be what will shape every other factors going into H2. To shape trade development is shaping it. Global growth has been shaped, just like you mentioned. And when global growth is shaped, the simple implication of that is global demand will sink. Now, for Nigeria example, our largest crude oil buyer are India and China, and because of the underwhelming expectation around their growth, it has been affecting our crude oil sales, coupled with the fact that prices are below our budget benchmark. So basically, geopolitical tension, either in terms of tariff or physical war, is the biggest risk, which can also bring back the issue of inflation at any point that the global economy is facing heading into H2 properly.
Mention drill, baby, drill. And I guess another thing, Trump wants is cut, baby, cut. At this time, we've seen many central
Absolutely.
bankers, including the ECB, SARB, they've cut rates in H1 2025, while the US Fed, they've held steady. How do these, divergent monetary policy paths in major economies, how does that influence, global capital flows, particularly towards emerging markets like Nigeria?
So I think emerging markets like Nigeria are more sensitive to what happened in the US than the rest of the world. The reason is simple. The USD is the global currency of trade. The US is the largest economy. Yes, in recent years, remittance number shows that a bulk of our remittance comes from the UK. But the reality is that most of those funds, when they are to come in, they still come in the US dollars, unlike pounds. So basically, and when you look at Nigeria foreign investment dimensions, inflows from the US is the largest. So remittance, the largest is from the UK. So by and large, when rates in the US are very attractive, are very juicy, attraction towards emerging market like Nigeria is always very low because investors will want to stay within the safe havens. And so as much as there are higher rates in the US, investors will prefer that than Nigeria. Now, tying down to what Trump is saying, Trump's leadership philosophy is very clear. He wants accelerated growth and he wants subdued inflation, which is like redefining economics law in the real sense, because typically economic theory and data have suggested that there is actually a positive relationship to a large extent between inflation and growth. So when you want accelerated growth, you must also be ready to witness some level of inflation, because what drives growth? Growth, except for countries that have structural challenges like Nigeria, in countries where there are no structural bottlenecks, growth comes from expanded consumption, expanded investment, and investors are more attracted to, especially those that are setting up business. I'm not talking about those that are investing in instruments. Those that are setting up businesses are attracted to countries where they know the political environment is secure and the interest rate there is cheap, so that they can borrow cheaply and set up their business and drive it. And it is in the doing of that that they can employ more people. And as they employ more people, those who have money to drive their ends meet their ends meet, consume, and that's what drives growth. So it's like I will summarize that Trump wants to hit his egg and have it. He wants growth to be accelerated. He wants oil price to be as low as possible, because one of the major drivers of inflation in the US is energy price, and that's why he's influencing the global oil prices as much as possible, even encouraging OPEC to pump more, because the more the oil in the market, the higher the likelihood that oil price will be subdued below $70, which will be good for the US economy in terms of managing inflation. Now, when oil price is subdued, because their own economy is a very shall I say, is well structured. Credit system is very solid there. It can also help drive growth, which although in the medium to short term can also then lead to a more terrible inflation, because if productivity growth is not as fast as consumption growth, which is what will actually happen, because if you give 10 people money, it's easier for 5, 6, 7 of them to spend it on buying things than transform into a business that will, drive productivity. So by and large, even though Trump's ideology might deliver a sort of, if he's able to push through the Fed, even to cut rates, might deliver a sort of immediate reduction in inflation and growth for the US to boost its political egoism that I'm driving growth and I'm keeping inflation low, but it's like a time bomb. The two don't normally go that way. When you want accelerated growth, you must be ready to see some inflation. And that's why the Fed are very careful, because the Fed knows that when, in an economy where inflation boomerangs, right, you are likely to send more businesses out of business, send more people out of their early grave, than when there is at least mild slowdown in growth. But as for the effect in the Nigerian economy, the more if the Fed should dance to the tune of Trump, for instance, and cut rate by as much as he has requested, which I don't think an independent Federal Reserve will do, the immediate effect could mean that attraction towards fixed income assets in emerging markets might pick up. And we have seen that in terms of numbers, even though official numbers have not come out to reveal the exact number. But based on NGX's monthly foreign statistics indicator, in Q1 and Q2, we have seen more foreign investors participated in the market because they are beginning to see values. Yield environment, the US is beginning to thin because of so many things. So basically, a rate cut there could be good for investment attraction. It could also be good for remittance because it then means that an average person there who is also a Nigerian who is into a business can invest, can borrow at cheaper price. Put it in their business, make gains, and they can easily spread it. But it will also have a negative effect in the medium time, because by the time that then boomerang and turn to accelerated inflation, because productivity is a bit sticky than consumption, then it will backfire. And again, like I said, Trump is trying to eat his carrot and still have it. He's trying to force energy price down, which should have been something that a country like Nigeria should enjoy from, because like this year, our budget benchmark is $75. And 4 out of the 6 months that have gone, oil price has traded below, on average, $75 in 4 of it, which is telling already on our revenue, plus other domestic factors that is negative for. So It's a mixed bag, but I think we just watch and see how events unfold, and we hope our policy makers will be able to adjust on time to get the best out of every situation that the U.S. economy triggers. But the reality is that when the U.S. economy sneezes, every country of the world catches cold. The extent then depend on how the policymakers are able to tinker with their policy variables.
Right. At this point, you need to find that hedge, once you see volatility with the oil markets, because that's our biggest, revenue earner there. But, let's drill it down now to the basics at this point. What are you seeing for inflation in the second half of 2025 for Nigeria and the Naira? Do we still see stability for the Naira or some kind of strengthening?
Let me start from the FX one. I think the central bank has done a yeoman's job over the last couple of months. One of the major drivers of FX volatility in Nigeria, as we can all recall, especially even before this government liberalized the FX market in 2023, let's say what happened between 2018, 2019, after the FX was stabilized around 309, and 2022, what has actually been the major driver, where we have the gap between official and parallel market rates almost about 300 level, is speculation. Now, the CBN has tried as much as possible to suppress that to, I won't say maybe this is the BRS minimum, because I feel for every height you attain, you can do better. But the CBN has done a yeoman's job by improving the transparency in the FX market and the ability to also sustain OMO bills yield at attractive rates has been pivotal to the performance of the Naira this year. Yes, you might say that the Ghana cedi has done better than Nigeria, but the environment differs. So looking at the reserve level, looking at the fact that our import bill, so to say, seems to have gotten some relief, especially with Dangote supplying some certain retail people locally. The import bill in terms of dollar need has also reduced. So if you look at some of those developments, you think that, plus the fact that the reserve is still around $37 billion level, you think that the outlook for Naira in H2 is not bad. We're likely to have it stabilize, even if it's not going to appreciate, because for it to appreciate, there must be a significant carry trade opportunity in Nigeria. There must have been major rate cuts in advanced economies, where those one would now see AME as the next grant. But with shocks around the world, we might not see as much rate cut as most analysts will have anticipated at the beginning of the year. So given that, I would say that the Naira stand a greater chance of remaining this stable for the H2 than maybe any appreciation. But for a major depreciation, that is not likely on the card, except crude oil price crashed significantly below $65, and our production also retreated, because even in terms of oil production too, we have moved towards both crude and condensate to about 1.67 million barrels, which is very good, though we are still far from the budget target of 2.0. Now, concerning inflation, the factors driving inflation, the success on it has, let me say, the progress we have recorded has been diverged. One of the drivers of inflation is this exchange rate, which the CBN has done a yeoman's job to stabilize. But we also have the other factor. That's why I said for countries that have structural problem, the policymaker just have to be on top of their game. We have a lot of structural issue that holds negative outlook for inflation. One of it is insecurity. We've seen what happened in Benue and some major agrarian belts. And one of the things that affected everybody, irrespective of your income class, is food. So with insecurity heightened in those part of the region, that might weigh on food prices, which is not good. And also the recent shock, in the global market concerning oil price briefly had led to some major importers, increasing PMS price slightly. So if there's no energy shock, then the other shock locally, insecurity, business environment, the government, especially the fiscal side, because the reality is that while we are seeing some silver lining from the monetary side, the fiscal side seems not to be pulling their weight very well, because you have insecurity in agrarian belt, you have massive oil theft in the Niger Delta region. Those are the two major sources of revenue for the government to make life easy for the citizen to control inflation. So as long as that is not, being holistically done, then we might still stand a risk of having inflation, weighing on household. But in terms of the statistical number, because what most people ask you is that what the NBS is saying now, the reality is a bit divergent. And the reason is because of the rebasing. So in terms of statistical dynamics, the NBS's inflation number is likely to remain on the decline, at least between now and say October, maybe a mild uptick in November, and there will not be a sharp uptick in December because of the very low base. At least December, several simulations have suggested that December inflation will be above 32, 33 level, which will be a spike, and that was just because of the rebasing. But how does it affect an average citizen in terms of standard of living? It will affect them in terms of how much they buy food, how much they take transport, how much they pay for drugs, the basic necessity, energy. Now, with the dynamics of what is happening in the economy, even with stable exchange rate, the insecurity that is creeping in or that is becoming more expanded holds negative for food. And once food prices is high, you can't expect people to think that the government is doing any, especially the average person. So by and large, we have, in terms of reality of inflation, there is an upside risk. But we think the federal government, if they pull their weight, address insecurity both on oil and food item, Nigerians can enjoy some relief in H2.
Right, and we definitely need that relief, at this point. But thank you so much, Damilare Ashimi, who is a macroeconomic strategist at Afrinvest Research and Consulting. Thank you so much. Enjoy the rest of your day.
Thank you for having me.